wrote in my notebook. I won't repeat them all. I think we've learned that we need to think more about a differentiated view of capital going into low-income countries. So different types of capital are important. We've also heard that capital flows are volatile, and that I think is an important point that we may want to discuss further as well. So capital flows can be volatile. Do countries actually need to just absorb that volatility and just let it go, or do they need to actively manage it a bit more? There was a view on actively doing a bit more managed approach towards foreign direct investment anyway, irrespective of a crisis. And then, of course, what can the sort of international community help? Can it help? What's the role of development finance institutions? Could they play the counter-cyclical role, perhaps? But what we have now is about half an hour, 25 minutes, time for questions. What I'd like to do is sort of ask you if you have any questions. Identify yourself and speak in a microphone so that everybody watching online can also hear the questions. And then I'll then ask the panel to answer the questions. Who would like to go first in terms of questions? Joe.
Joe Hanlon from the Open University. Listening to Isabella, something jumped out at me that then Matthew actually raised, which is the whole question of finance internal to companies. And I'd like to get a little bit of expansion on that, because not only are companies borrowing from within the company, but a lot of the financial flows are within the company. On top of that, of course, you've got all the historic transfer pricing issues. And one of the things that I've seen in areas that I work is that the leverage issue becomes important internal, because you get situations of people getting a license on the basis of a promise of investment capital, and then using that to borrow money, pretending that that's their own investment, and that within the countries you have no idea what is going on. And these very large corporations, Mozambique, where I work, Val and Riversdale are currently the biggest investors. You have no idea what those companies are doing with those large investments that are internally within the company. People are flying in and out of the country into local airports. You don't even know who they are, what they are. The lawyers, I know some of their lawyers who are working on the internet. I mean, they just seem to have no relation to what goes on in Mozambique at all.
Mm-hmm. Okay, Joe. Gentleman there.
Mark Napier, I'm an independent consultant. Thanks very much to the speakers. It was really interesting. I think the comments about getting better data out of developing countries seems to me to be really, really important. I think we've all been struggling perhaps with this lag in data that we get through this global crisis, and to know really what the effects are. And we're still, I think, probably working at sort of 9 to 12 months out of date, I guess, and there could be quite significant changes have taken place since then, perhaps. Just 2 points of clarification. One, Isabella, for you. You made the point about, obviously, FDI. Could you just clarify? I mean, FDI is characterized sometimes by very big, lumpy flows, isn't it? And I just want to ask you whether there were any particularly big lumps that were causing the volatility, whether these were sort of deferrals of telecoms expenditure or big investments in mines or whatever that might have caused some of those particular flows that might have caused the numbers to be a bit distorted or not. And the second point, Michael, just to ask you, Matthew, to ask you to clarify what you meant about private charity, the comment you made just at the end there. I mean, surely if there is a $64 billion hole, that's probably quite a good opportunity for the private sector to start looking at opportunities there. And I thought your colleague was actually not talking about private charity. This was private self-interestedness. Thanks.
Okay, maybe we should take these two questions first. There's an important issue also about data that has been mentioned, and that's something that we've also found here, isn't it, at ODI too. If you look at investment in African countries, then a lot of it is channeled through a tax haven, as you mentioned, and so Brazilian investment in Mozambique, for instance, is very often channeled through the Netherlands or something like that. And it's very hard to get at the exact data. You need to do a lot of data mining, and that's very important. I think, do you want to ask some questions first, Matthew, and then maybe Isabella, you want to ask a question?
I think I'll let Nils talk a little bit about the data issue. I would say, I mean, absolutely, I agree with Joe Hanlon's point that it is very important to know what's going on inside the companies. What the countries are able to do, and clearly one can't talk about that too much in public, is to look at the numbers that have come in and see what that means about the behaviour of the individual investors. So they do actually have access to all of that. They can compare it with all the company financial statements and so on. However, what they have done is guarantee to all of those investors who reply, in case any of them are listening, that none of that information will go to the tax authorities, because it's absolutely clear this needs to be kept as a confidential balance of payments related and investor perception related exercise. But you're absolutely right. I mean, we did find a few years ago, in a very extreme case when we first started working with Tanzania, that as the Tanzanian senior people in the investment centre put it, when they'd done the survey, they thought that they'd found that 75% of the people who came to them for investment licenses actually did no investing. They mainly imported and got duty-free status for those goods on the basis of their investment licenses. And 75% of the people who'd replied to the survey that they were investing never came anywhere near the investment promotion centre. So that they used that as a major way to improve both their monitoring and their promotion in future. On the private charity bit, I mean, I think Nils made the point in his part of the presentation that it's really important that this is seen as an integral part of a private sector business model. I think that the problem too often is that if you use it as part of a private sector business model and you say we are in a particular region or a particular country, not just to make profit, but actually to sustain our own business model by making sure that there is sustainable infrastructure and sustainable social services and so on, fine. You will tend to work with the government. You will tend to say, maybe we can pay more taxes to the government so that they can spend the money instead, or maybe we can have a public-private partnership and so on. But the example of Anglo that I was giving, and at the time, as we were about to produce our old book, we almost had a big box saying Anglo-American, great example of corporate social responsibility. But the problem was that Anglo-American then took this decision on very good business basis, which was that they thought that Zambia was not, and copper were not particularly profitable things to be in at the time, but kind of forgot that all of this corporate social responsibility add-ons were going to be cut off. And I think they were still seeing them as add-ons, and that was the problem, because if they were seeing them as part of their business model, they might have thought again about withdrawing from that, particularly as now copper is once more extremely profitable in Zambia. So I think it's really about integrating it into your business model. If you do that, you won't take decisions, you won't have volatile, that's why I called it private charity. What you don't want is private charity. What you want is private provision integrated into their own business model, and then it will be sustainable. Nils, you want to say something about data and legs?
Yeah, I share Joe Hanlon's concern, and I think a lot of the countries we're working with have been made aware of this in the exercises that they've been doing. One of the points that was raised in the presentation was that previously FDI, for example, and other types of investment into low-income countries were assumed to be FDI, equity-based, long-term, sustainable, etc. But what these studies have found is that when you break that down, you find very high components of what was thought to be equity is actually debt. What was thought to be long-term can actually be short-term. And when you look at, say, company borrowing, for example, you'll find it doesn't come with specific terms and conditions about grace and maturity periods, interest rates, and so on. This debt can be rolled over to become long-term, or, as we've seen during the current crisis, it can be called back by a head office, which needs the money very quickly. And this makes the flows a lot more volatile. And seeing as FDI is one of the major flows to these countries, this raises a lot of concerns for the sustainability of the private flows. Countries are addressing this on a monitoring and analytical level with very comprehensive questionnaires. And these questionnaires are in line with IMF codes and standards, and they go beyond those codes and standards by asking for additional details. However, the main concerns relate to the timeliness of that data, and countries need to obtain that data a lot more quickly. IMF standards say 6 months, but we think it needs to be 3 months at least for it to be of use. And in addition to that, we're working with countries at the moment on developing early warning systems as well to see what might be the future trends with respect to equity and debt flows and potential risks of reversals as well.
Okay. Isabella, there was a question about lumpiness of investment.
Yeah, so about this issue of getting better data, I really agree with you. And indeed, even when we revised the paper just after 6 months, I mean, the data have changed, and there were much more data available than the first time that we do this study. And of course, I mean, your point is a very good one. And I think that in our study, by taking out South Africa and Nigeria, that are the two biggest countries attracting foreign direct investment, we have control to a certain extent the issue that you are mentioning. But of course, I mean, it's a very good point, and I'm taking note of it, and this is something that deserves to be double-checked in the study to be completely sure that there was no big investment in some of the countries within the sample that could have misled to a certain extent the results that could be the main driver of our results related to FDI.
Okay, thank you. Let's have another round of questions. Let's first have some online questions. Liam, if you...
Yep, we have a question from Ziad Mabsout at the University of Warwick, who asks, given the need of developing countries for foreign capital, because of the need to deal with current account deficits and the influence of market actors have on public policy of these countries, would it be considered that a decrease in portfolio bond investment due to the global financial crisis will give governments in developing countries the chance to involve in reforms and get back some lost policy autonomy? Or perhaps is it the opposite?
Okay, thank you. Gentleman here.
Yeah, Tony Kingsley from PricewaterhouseCoopers International Development Assistance Network. Just wondering, with the hole in the underestimations, Matthew's underestimations of foreign direct investment, and the fact that South Africa in Isabella's graphs was taken out with Nigeria of the equation, whether South Africa, Africa investing in Africa, is taken into account in this, maybe could account for a little bit of that gap, because certainly when you're in East Africa, South African investment is the most visible in terms of infrastructure and shops and outlets and so on.
Okay, thank you. And behind you. Oh. Well, Jan first and then behind you.
Yes, Jan Toporowski from School of Oriental and African Studies, London. One query about the data, or comment about the data. I think people are talking about getting more and more reliable data, and I do wonder whether as one gets more data, the data is getting more reliable, or is it not just reflecting certain structural changes in international financing, and in particular the gradual integration, the slow integration of sub-Saharan Africa into the international financial system, which at one time the IMF thought we considered was a factor protecting sub-Saharan Africa, and obviously with South Africa standing out as maintaining particularly strict capital controls, and then alongside that changes in the kind of financing of flows and securitization, which means that you're having bond issues and possibly even equity issues, which are really refinancing and securitizing various types of receivables. So there's that which leads me to be rather sceptical about the possibilities of better data, because that's what's being picked up in the aggregates. My query, my worry about a lot of this discussion, is particularly addressed to Isabella, is the way in which one talks about global financial crisis. In fact, if you look at macroeconomic data, it reflects not just a global financial crisis, but it reflects very extreme volatility in commodity prices, in commodity markets at that time, which didn't collapse, so they weren't part of a crisis. So I think one has to be careful about talking about global financial crisis.
Okay, thank you. I think there was one hand, and then I'll hand over to the panel.
John Garrett from WaterAid. Yes, thank you very much for the presentation. It's very interesting. I'd be interested to hear a little bit more on how the different sectors in the economies of sub-Saharan Africa and elsewhere in low-income countries have been affected by the boom and bust in private capital flows. And also, more generally, if you could maybe say a little bit on the lags impact on economic growth. I mean, you've talked about and shown how we've seen the big volatility in private capital flows. I'd be interested to know what the lag is in terms of the impact on economic growth, and also how that lag will play into the recovery in private capital flows and the recovery in economic growth. Thank you.
Okay, thank you. Matthew, would you like to?
You want to go the other way this time?
Would you like to go first, Isabella?
Yeah.
Yeah.
Yes. So just probably some comments on the last two questions. So about the last question about which sectors have been affected by the global financial crisis, I think that this is very country specific, and in particular, if we look at the evidence provided by the country case studies that we have recently conducted, it appears that, for example, in Zambia, the mining sector have been one of the most affected by the global financial crisis. And of course, this has been something that stemmed out from a combination of the global financial crisis plus the falling copper prices. And then in Cambodia instead, and in Bangladesh to a less extent at the beginning, but then increasing over time, the garment sector has been one of the most affected. So, I mean, it really depends on where before the crisis investment has been directed. And at least on the countries that we have investigated, the mining sectors appear to be one of the most affected by the global financial crisis. But again, we have also some other evidence related to the garment sector. And as I told you before, the effect was much stronger since the beginning in Cambodia rather than in Bangladesh, because there was this positive role played by the Walmart effect in Bangladesh that helped the country to be much more resilient in the first phases of the crisis. But still, especially in 2009, the effects started to become evident also in the garment sector in Bangladesh. And and again, my point about the effect, the lag effect that the volatility of private capital flows can have on growth. I mean, it's very difficult to have an estimate of how long will it take to have this. And what I believe is that this is really dependent on which kind of policies are in place within countries. Because if countries have developed already some good risk management technique, and they are relying on a sound policy framework. Of course, this issue of the volatility associated with private capital flows is likely to be more controlled by these countries rather than countries that have a very weak supervisory framework and where prudential measures has not been taken into account in the past.
Yeah, I mean, I think that's an important point about sort of lagged effects. So you can think about lagged effects on growth, but as Mark mentioned, also there's a lagged monitoring effect as well. So we sometimes monitor something that's happened half a year ago, and things have moved on so quickly in this crisis that it's unbelievable that copper prices are now back to the record levels. And what Isabella also described was the how quickly capital was withdrawn from Uganda, the stock market, but actually now it's gone back up very, very quickly as well. So the exchange rate depreciated very early on, but now it's been appreciating, and it's been so quickly how things are moving. And now Africa is again a frontier market. Everybody's investing in it again. Emerging markets are now having to stop capital inflows, thinking about capital controls and the like. Things are moving so quickly with this, and I think it makes it so important to think about sort of the volatility and managing volatility as well. Matthew, your turn now.
Okay. On the question we had from online about bonds and whether they give you policy autonomy. A lot of countries were thinking of issuing bonds before we got to the crisis. They can't at the moment because the international markets wouldn't accept it, and judging by what Greece is going through, the spreads would probably be astronomical. Although actually probably most of the low-income countries have a lot more responsible and balanced financial situation than Greece finds itself in. But anyway, I think it's important to say that bonds can be useful in very limited circumstances. They can be useful for very high return projects if they don't get you back into a debt crisis, and if they give you a certain degree of, I would say, project autonomy, because it's true that there is a lot of infrastructure out there which needs to be built, which could be very high return, and which a lot of donors won't fund because they want to put most of their money into health and education and social sectors and so on, and are rather reluctant to spend it on ports or energy and so on. The exceptions to that being the Chinese and the Indians, which is why a lot of countries are dealing with them more. But I think you need to be very careful what you do. Ghana is a really salutary tale in this respect. They issued that $850 million bond. They didn't quite have the projects ready. It sat in reserves in the central bank, earning virtually nothing for almost a year. Nobody's quite sure where the proceeds eventually went in an election period. And nothing has come out of that bond at all. And yet I think it's 7 years from now, Ghana's going to have to find $850 million to repay it. So they thought they had policy autonomy. And at the time when they took out the bond, I think they had every intention of using that money for a great deal of good, but it didn't happen. So I would certainly go nowhere near the theorem propounded by Dambisa Moyo that what you should do is switch away from aid to bonds, because bonds they can give you autonomy, but they can also give you a huge macroeconomic problem, and they cost a fortune. And apart from anything else, the bond issuers don't really care what you spend the money on. I was very interested by Isabella's results on bank lending, and I was wondering whether it's perhaps because most of the bank lending going to Africa now is going into private sector projects, which are generally reasonably well structured, or to finance trade, and therefore it's actually having some impact, whereas the older studies were probably looking at bank lending partly to the private sector, which typically went into to the public sector, which typically went into white elephant projects or funding government deficits, which was not the best use of them. So what you do with the money is the most vital thing, and the idea that African countries should just go rushing onto bond markets is a really disastrous one, and is unfortunately being promoted by some bond salespeople as we speak. There's a huge South African presence. I think I showed a slide relating to Tanzania, but we find that in pretty much all the English-speaking countries, increasingly in the French-speaking countries as well. I was in Cameroon a couple of months ago. Lots of South African businessmen sitting in all the hotels negotiating new contracts. On the issue of sectors, I would say probably it's possible to categorize them into three. The ones which were really closely linked to the global commodity markets, most of which, with the notable exception of gold, went into meltdown for a while and now are recovering. And you have a big lag there in investors' decisions, so a lot of them got very scared off by the meltdown, not quite sure whether they want to go back in again. Other sectors, and I'm sure Nils could say more about this, but like notably in the Gambia, real estate and tourism, which were also sort of linked into global booms, and have suffered tremendously from the crisis as a result. But those are probably partly sort of speculative booms. I think it's unlikely that those will relaunch themselves after the crisis quite as dramatically. And then a third set of sectors which were really much more to do with being dependent on domestic demand, as Nils put it, market seeking. And those, I think, are the ones that have been the most resilient ones. And you do hear a lot of investors in low-income countries now going, actually, you know what we should be investing in is manufacturing or retail or something that actually really is linked to the domestic economy, because then we won't be subject to all of this volatility. And finally, on volatility, I mean, I think I agree with Willem that there's been some recovery. But there are, as we all pointed out, there is still a stagnation, if not a fall in FDI. There is still a great deal less money available than there was. And I think in terms of analysing volatility, I mean, every study that's ever been done says, in a sense, it almost doesn't matter what your policies are. The absolute worst thing for your growth is to have volatile policies or shocks hitting the economy. And the worst thing for the MDGs is the same. But the message we were trying to get across is if you want to look at that volatility, you need to look at it not in a sort of a global, what's the relationship between volatility of capital flows and development way, but you need to look at it in a more disaggregated way. And I think that the solutions need, of course, to have the macro framework and the supervisory regulatory stuff, but they also need to have the very detailed flow-specific types of solutions that we were talking about as well, because otherwise you will find that, I mean, as we've seen in the global financial crisis, we have seen a tremendous amount of how the private sector is able to avoid almost any type of regulation or supervision, and I don't think low-income countries are going to be any better at containing things through those measures.
Okay, thank you very much. Nils, do you have
I just add a couple of
final
things.
remarks?
Yeah, there's in the book you'll find a more detailed description of the real estate sector in the Gambia. It was interesting from the point of view that we developed an approach with the International Monetary Fund to track unincorporated FDI into real estate, which was primarily held by individuals from Britain, Germany, the United States. And they saw the value of their properties and rental income decline directly as a result of the global crisis. And after a boom in real estate, so it dropped quite significantly after that. In response, an observation on the comment on data quality. When countries first started collecting this data, they were using residuals in the balance of payments, or they were collecting based on, say, approved investment from investment promotion agencies or other sources. We've seen marked improvement over the years with the countries we've been working with, countries doing enterprise surveys which are collecting data in line with international codes and standards. It's one thing to meet those codes and standards, but it's something else to get good quality data within those frameworks. And they've been addressing that through very intensive liaison discussions with the private sector, getting them on board, moral suasion, persuading them that it's in their interest to respond to the exercise, reporting back with detailed analysis such as this. So I'd say on a country data quality level, we have seen improvements, but there is still a lot more to be done. As I mentioned earlier, especially with respect to timeliness and developing early warning systems and so on.
Okay, on that note, I think what I've heard is a plea for a deeper understanding of different types of capital flows. That's going to be very important. But I also hope that you've all learned a bit more already on the basis of these three excellent presentations. And I hope you will all have a look at these publications and have a look at the website as well. Thank you for coming to this meeting, and I hope to see you again at another meeting. Thank you. Thank you.